Welcome to the Deep Dive. It's Friday, July 18th, 2025. Today, we're cutting through the noise, getting you those vital insights from, well, a real whirlwind of high-stakes decisions shifting markets, and some pretty fascinating glimpses into how global forces are hitting your daily life.
Yeah, our mission today, really, is to unpack a whole stack of fresh sources articles, research our notes, and show you the connections. The surprising links between, say, the Federal Reserve's fight over interest rates and the nitty-gritty of big corporate mergers, even, believe it or not, what sweetens your favorite drink. We will pull out the key nuggets, maybe deliver some aha moments, and give you that shortcut to being genuinely informed on the stuff that matters. Get ready to connect some dots, maybe in ways you didn't expect. So, okay, let's dive right into the Federal Reserve. What's immediately striking is this intense tug of war happening right now. We've got President Trump, consistently pushing hard for rate cuts. He wants them down to 1%. And he's been really vocal, criticizing Fed Chair Jerome Powell's policy, calling it lousy, even talking about potentially firing him. From your perspective, what are the real dangers here when a central bank's independence gets questioned like this?
Well, what's fascinating and maybe a bit concerning is how this politicization could play out. There's actually JP Morgan research warning that historically, central banks with less political independence, they tend to face higher inflation risks down the line. It just highlights that delicate balance the Fed tries to maintain. Their independence is, well, it's pretty crucial for long-term price stability.
And it's not just about the interest rates either, is it? The president's also really fixated on the Fed's headquarters renovation, that $2.5 billion cost overrun in D.C. He keeps emphasizing it's Fed money, not taxpayer money, funding it. And Chair Powell actually sent a formal reply to the White House about it, stressing transparency, accountability. But beyond the public back and forth, how does this kind of scrutiny actually impact the Fed's day-to-day, their ability to operate effectively?
Oh, it definitely creates a challenging environment, no doubt. What's also interesting, though, are the differing views within the Fed itself. You've got Federal Reserve Governor Christopher Waller, for instance. He supports a rate cut down to 3% from the current, 4.25 to 4.5 range. And he's citing slowing consumer spending, slowing job gains, basically arguing the Fed should look through the tariff effects. But then you have Chair Powell sticking to this wait-and-see stance. He specifically wants to gauge the economic hit from Trump's tariffs. So this internal debate just shows how complex these decisions are, even before you add the external political heat.
Okay, here's where it gets really interesting, I think. The picture of the American consumer, it feels surprisingly contradictory. On one hand, you have major companies, banks, looking at June's retail sales, which were actually above forecast. And they're describing consumers as resilient, still spending. But then consumers themselves, they're reporting feeling real financial pressure. What's driving that disconnect?
Yeah, it is a disconnect. And the University of Michigan's July consumer survey gives us a clue, maybe. It shows the inflation outlook actually tumbled back towards pre-tariff levels, the one-year forecast. Plunged to 4.4%, down from 5% in June. And the five-year outlook slid too, 3.6%, down from 4. Now, those are the lowest since February this year, which sounds good. But, and this is crucial, they remain above where they were back in December 2024. Remember, those were 2.8 and 3%. So while perceptions of future inflation might have eased a bit, consumers still see a higher risk than just a few months ago. That's where the tension lies, I think.
Right. And despite that sort of mixed feeling from consumers, bond market traders seem worried. They're flashing worries about long-run inflation. We're seeing the five-year break-even inflation rate climb above 2.5%. For our listeners, what exactly does that specific number tell us? What are the market's expectations, and why does it matter right now?
Okay, so that break-even rate, that's essentially what bond traders are pricing in as the average inflation over the next 5 years. The Fed's target is usually around 2%. So seeing it go above 2.5%, that signals the market expects inflation to stick around higher than the Fed would like. And they're likely factoring in these new tariffs, seeing them as a potential driver of sustained price gains.
And those tariffs, they're significant. Trump's talking 30% on imports from Mexico and all 27 EU countries. That's on top of the 50% levy on Brazilian copper and existing tariffs on, over 20 countries. And now he's reportedly demanding at least 15 to 20% minimum on EU imports. So how are these policies actually starting to hit consumers in the real world?
Oh, the impact is definitely starting to filter through. Look at 3M, for example. They gave a pretty downbeat outlook. They cited a sluggish economy, a subdued consumer, weakening demand for electronics. And more broadly, a survey found 78% of consumers say these tariffs make it harder to deal with their debt. Most economists expect the full hit on prices to really pick up in the second half of this year, as companies burn through their existing surplus inventories. But there's another wrinkle here. One financial expert actually argued that cutting interest rates now would fuel the market's good position.
That's an interesting take. Fuel a good position, especially with all these tariff clouds gathering. Can you maybe elaborate on what that good position might mean from this expert's view?
Yeah.
I guess, what are the counter arguments, considering these escalating trade tensions?
Well, this expert's argument seems to focus on the idea that lower borrowing costs could stimulate investment, boost spending, basically offset some of that drag from the tariffs. It implies a kind of confidence in the market's underlying strength, its resilience. But yeah, many economists would push back hard on that. They'd argue that significant tariffs act like a tax hike, plain and simple, for consumers and businesses. That could potentially stifle demand, definitely add to inflation, and just create a ton of uncertainty that discourages investment, no matter what interest rates are doing. It's really the key debate right now. Which lever matters more for the economy? Monetary policy or trade policy?
Okay, moving beyond the Fed then. The corporate world, it's making its own big moves, navigating this whole complex landscape. We're seeing a lot of M&A activity, especially in more traditional sectors, and also some really fascinating shifts in how tech companies are handling AI, their workforce. What's standing out to you in terms of major industry shakeups?
Well, the energy sector is definitely consolidating. You mentioned Chevron. They just successfully closed that huge $53 billion acquisition of Hess. And importantly, they won that arbitration dispute against ExxonMobil over Hess's stake in Guyana's Stabroek block. That was critical. Chevron CEO basically said the ruling confirms what they see as standard practice. Asset-level rights of refusal don't block corporate mergers, so that clears the way. And now Chevron expects, quote, some headcount reductions as they integrate Hess. They were already planning layoffs, maybe 15-20% of their workforce since back in February, so more cuts likely coming.
And it's not just oil and gas heating up like that, right?
Yeah.
We're hearing buzz about potential mega mergers in other sort of foundational industries, too.
Absolutely. The railroad sector is another one. There's serious M&A chatter around Union Pacific and Norfolk Southern. Union Pacific is reportedly in talks to acquire Norfolk Southern, if that happens. Wow, you'd potentially create this railroad mega carrier, a massive transcontinental network. These kinds of huge consolidations, they often reflect this push for greater efficiency, for market dominance, especially when companies face economic headwinds like these.
Right. Okay, shifting gears a bit to tech. Alphabet stock, Google's parent, it's on an 8-day winning streak, longest in about 10 months. Analysts seem generally pretty upbeat before their Q2 earnings, even with those, lingering worries about Google search in an AI world. And then you have Micron Technology. Their stock's down 8% this week.
Right.
But analysts are seeing it as a chance to buy the pullback. They think Micron's well-positioned for the long haul, AI chips, custom silicon demand, even with broader memory market concerns. So it seems like investors are still finding pockets of opportunity in tech, despite the jitters.
They definitely are, and it's a really critical time for the sector. If we try to connect this to the bigger picture, look at Dell Technologies. It's a really compelling, maybe cautionary example. You see this tension playing out. Rapid tech advances, cost-cutting pressures, and trying to keep employee morale up. Their employee satisfaction rate, it's plummeted, down to a score of 32. That's nearly a 50% drop in just 2 years. And employees, they're pointing to ongoing layoffs, 25,000 cut in 2 years. Plus a strict 5 days a week return to office policy, AI implementation worries, a culture shift.
Wow, that Dell data. Satisfaction plummeting like that, even while I think the source said leader scores were still high, it really underscores that tension within big companies today.
It's a stark reminder, isn't it? Behind the market gains and the tech leaps, there's always a human story. How are other sectors, maybe like airlines, handling similar pressures, especially with consumer habits shifting? Absolutely. That balancing act, growth, efficiency, employee well-being, it's a constant struggle. Dell's data just makes it really visible. In the airline sector, you see different dynamics playing out. Delta and United, they seem to be pulling away from the pack.
Yeah.
They accounted for, over 86% of the profits from the 7 largest airlines last year? That's huge. And they're really benefiting from focusing on premium travel and that strong demand for international trips, especially trans-Pacific, like flights to Japan.
So focusing on the high end is working for them. But what about just regular domestic travel?
Yeah, that's the weaker spot. Domestic demand is actually softer than expected. Seems there are too many coach class seats out there, which pushed airfare down 3.5% in June compared to last year. And as a result, both Delta and United have actually trimmed their outlooks for 2025. American Express data kind of backs this up too. They report their richer customers are spending freely overall. But travel spending was weaker, specifically flat spending on airlines, driven down by those lower economy domestic fares. However, and this is key spending on premium cabins, up 10%. Hotel bookings over $5,000, up 9%. It just reinforces that idea that economic pressures aren't hitting everyone equally. The premium end seems pretty robust.
Okay, now let's shift to some really cutting-edge stuff. Frontier tech, controversies, local impacts, starting with crypto. Looks like a potential breakthrough moment here. President Trump signed the Genius Act stablecoin legislation into law on Friday. That's being called the first major U.S. crypto law. That feels significant.
Oh, it truly is a significant step, a landmark, really. And look what happened right after. Ether climbed 19% this week alone. It's up 43.6% over 2 weeks. That's its strongest 2-week run since way back in August 2021. And it hit a 5-month high relative to Bitcoin. Plus, Ether ETFs. Record daily inflows, they actually topped Bitcoin ETFs for the first time, pulling in over $600 million one day, over $700 million the day before. And now Charles Schwab is announcing plans to offer Bitcoin and Ether trading, then a blockchain offering later. You even have Robinhood CEO Vlad Tenev saying he believes crypto tech will power the entire financial system. And don't forget the broader Clarity Act for crypto market structure also passed the House. Now it's heading to the Senate. This really does feel like a turning point, integrating crypto more into mainstream finance.
That's a powerful statement. Power the entire financial system. Wow. And speaking of tech intersecting with, well, politics and ethics, we've got this interesting situation with Elon Musk's Neuralink, the health tech company. They labeled themselves a small disadvantaged business, SDB, in a federal filing back in April. This was just before venture investors valued the company at $9 billion in June. $9 billion. And this filing apparently went to the Small Business Administration while Musk himself was leading Trump's new Department of Government Efficiency, DOGE, which, as we know, has been focused on streamlining agencies, but also actively targeting DEI initiatives. Can you just explain what that STB designation actually means and why this might be raising some eyebrows?
Sure. The SDB designation, it offers preferential access to federal procurement opportunities. Basically, a leg up in getting government contracts. It's intended for businesses that are at least 51% owned and controlled by people considered socially disadvantaged, economically disadvantaged. Now, the Department of Justice has actually fined companies in the past for making false SDB claims. So, yeah, the optics. A $9 billion company led by one of the world's richest people seeking this status, especially while that same person is advising the government on efficiency, including scrutinizing programs like this. It's certainly worth examining closely. It kind of highlights the complexities, maybe even potential loopholes, in federal programs that are meant to help genuinely disadvantaged businesses.
That is quite the juxtaposition indeed. And staying with big tech and regulation, Meta Platforms announced it's not going to sign the EU's new AI Code of Practice. Their global affairs chief, Joel Kaplan, called it an overreach, said it will stunt growth, and basically stated Europe is heading down the wrong path on AI. Now, the EU's rules for general-purpose AI models, they go into effect next month. They're meant to create a framework for complying with the AI Act passed last year, focusing on transparency and safety. But interestingly, OpenAI, they did commit to signing the code. What does this split tell us about the global conversation on governing AI?
This divergence, Meta saying no, OpenAI saying yes, it really highlights the fundamental debate shaping AI's future right now. Is regulation a necessary guardrail, for safety, for ethics? Or is it just an impediment to innovation? Meta's stance clearly suggests they're worried that rules that are too prescriptive could stifle the rapid development they feel is needed to compete globally. OpenAI's commitment, on the other hand, suggests they believe a clear regulatory framework can actually build public trust, provide a stable environment for developing AI responsibly. It's a critical tension, and how it plays out will likely define how AI evolves differently in different parts of the world. Though on a more, perhaps optimistic note, former House Speaker Newt Gingrich suggested AI use could lead to a more effective America. So, varying perspectives there, too.
Okay, let's shift from that global tech regulation down to some really local dynamics. We're seeing big policy debates flare up in cities like New York. The city's socialist mayoral candidate, Zohran Mamdani, he's proposing policies like, raising taxes on corporations and the wealthy, free childcare, city-owned grocery stores, also a $30 minimum wage by 2030, and an immediate freeze on rents for all rent-stabilized tenants. Now, one real estate expert warned this could trigger an absolutely catastrophic exodus of businesses and wealthy people. He even described the rent freeze as a form of communism that would force distress and maybe let the government acquire properties for community housing. This really sounds like a microcosm of those broader national economic ideological battles, doesn't it?
It absolutely is. And you see similar tensions, maybe from a different angle, playing out in California as well. A federal judge just blocked construction of a big development project, the 314-acre Stonegate project in Chico, California. This followed a lawsuit from environmental groups. The judge ruled the government's original 2020 approval was arbitrary and capricious. Why? Because the project would cause significant loss of local wetland and vernal pool habitats. And it would threaten endangered species, things like the rare Beep County meadowfoam flower, vernal pool fairy shrimp, giant garter snake. The judge also noted the U.S. Fish and Wildlife Service's assessment failed to analyze climate change impacts on these species. So this ruling, blocking Stonegate, it isn't just about one local project. It really highlights this growing trend where environmental rules, especially around climate impacts, are becoming a major hurdle for large-scale development. And that impacts everything from housing supply to local jobs, local economies.
Okay, so we've covered global economics, corporate moves, even these intense local policy fights. But how does all this high-level stuff actually trickle down into your personal finances? Let's look at something really fundamental, like your home equity. In this kind of dynamic, market rates fluctuating, housing prices still shifting, what are the most strategic ways to build wealth in your property, beyond just, making the monthly payment?
That's an excellent question. Because for most people, their home is their biggest asset, right? So strategic growth is key. Okay, first off, making a large down payment. If you can hit 20% or more, that helps you avoid PMI, private mortgage insurance, and it dramatically cuts the interest you pay over the life of the loan. Simple but powerful. Second, pay more than your required monthly mortgage payment. Even just one extra payment a year. That can literally save you tens of thousands in interest and shave years off a 30-year loan. More than 5 years, potentially. It's incredibly effective for how simple it is.
Right, those are about the financing. What about improving the actual house itself?
Exactly. That brings us to the third and fourth ways. Enhancing the property, updating the basics, things with a high return on investment, replacing a garage door, a steel entry door, even just repainting a room can boost value significantly for relatively low cost. Then you have the larger remodels, kitchens, bathrooms. Those can yield a really good return, maybe 50 to even 96% ROI, depending on the project and market. And the fifth strategy is refinancing if you can get a lower interest rate. That can free up cash flow, maybe allowing you to make those extra principal payments we talked about, paying down the mortgage faster. But you absolutely have to factor in the closing costs, usually 3 to 6% of the loan amount, to make sure it actually makes financial sense for you.
Okay, so building equity is one piece. But looking at the broader financial picture, especially retirement savings, there's a new survey from Schroders. It says the average working person believes they need about $1.3 million to retire comfortably. However, nearly half, 48%, actually expect to retire with less than $500,000. And only 30% think they actually hit that $1 million mark. That's a pretty big gap between aspiration and reality for a lot of people.
It really highlights the financial pressures many are under, doesn't it? And for those who do plan to travel in retirement, or even before, there are new U.S. travel fees to consider now. These could impact everything from tourism numbers to individual budgets. Travelers to the U.S. now face this new visa integrity fee, at least $250. This comes from the Trump administration's One Big Beautiful Bill Act, and it applies to all non-immigrant visas, so tourists, business travelers, international students, everyone. And crucially, it's in addition to other fees like the $205 application fee and the already increased $24 Form I-94 fee. Now, they say it might be reimbursable if you comply with your visa terms, no unauthorized work, don't overstay. But the details on how that works, how you get refunds, still really unclear. The U.S. Travel Association noted there are significant challenges and unanswered questions, especially with big events like America 250 and the FIFA World Cup coming up. And this is happening just as funding for Brand USA, the agency that promotes travel to the U.S., has been slashed from $100 million down to just $20 million. It signals a potential real shift in how the U.S. views inbound tourism.
Wow, yeah, those new visa fees definitely add another layer of complexity and cost for anyone planning international travel to the U.S. And speaking of navigating travel costs, especially in a world where, let's face it, economic situations can vary wildly, it brings up another important, maybe sometimes awkward point. How do you manage expenses when you're traveling with friends, especially if there are significant differences in budgets?
Oh, that's such a crucial point. It touches on personal finance, but also relationships, right? The key really is open and direct conversation about budget. Before you go, ideally, if a friend uses vague language like, oh, this place is affordable, or that shouldn't be too expensive, it's absolutely crucial to ask clarifying questions like, okay, what does affordable mean to you, roughly? Or can we look at the actual prices for that activity? And avoiding assumptions and having that proactive communication can prevent a lot of discomfort, awkwardness, or unexpected financial strain down the road. It just helps ensure everyone enjoys the trip without money stress hanging over it.
That's really practical advice. Okay, finally, let's bring it all the way back to the cost of everyday consumer choices, like the sugar in your soda. President Trump recently claimed Coca-Cola had agreed to switch back to real cane sugar for Coke sold here in the U.S. Now, Coca-Cola hasn't actually confirmed this, but it raises an interesting point. It might seem like a tiny detail, sugar type, but it actually connects to much larger economic forces, doesn't it? What's the cost difference, and why is this potentially such a big deal for a company like Coke?
The cost difference is actually pretty significant, and yeah, it's deeply rooted in agricultural economics and policy. Right now, refined white sugar costs about 1.01 per pound. That's up quite a bit from 0.61 back in 2015. High fructose corn syrup, however, is only about 0.35 per pound, also up from 0.27 in 2015, but still way cheaper than sugar. Why the difference? Well, high fructose corn syrup became the go-to cheaper alternative back in the 1980s. That was largely thanks to U.S. corn farming subsidies and just the sheer volume of corn grown here. It's our #1 crop. The Corn Refiners Association, predictably, warns that a big shift away from high fructose corn syrup could wipe out maybe $5.1 billion in farm revenue, and it could cause substantial economic ripple effects across major corn-producing states. So yeah, what seems like a simple ingredient choice for your soda, it actually has massive implications for farm policy, trade, international relations, and ultimately the price you pay for groceries.
So today, we've really taken a deep dive, haven't we, into this rapidly evolving landscape. We've seen how the highest levels of government, the biggest corporations, are all trying to navigate these huge economic shifts, tech advancements, public opinion, from that intense fight over interest rates and trade policy, all the way down to surprising details about employee morale at major tech firms. And yeah, even the type of sugar in your soda, it's all connected.
Absolutely. And we really hope you found these insights not just, informative, but genuinely impactful for understanding the complex world around you. Being well informed today really means understanding these intricate relationships, seeing how these different forces ripple through our economy and our lives.
So as we wrap up, here's something to think about. Consider how seemingly isolated headlines. Federal judge blocking a housing project to protect a rare flower. Or Elon Musk's Neuralink filing as a disadvantaged business, or even that debate about sugar versus corn syrup. They're all actually part of a much larger, still evolving story. A story about what we value as a society, how we define fairness, how we define progress in this complex global economy, what stands out to you about how all these different forces might shape our world next.